Hello, this is Mike Swanson, and the odds are you're watching this video because you received an email notice on my email list that it's been posted. Now, if you're not on my email list, you want to get on it so you'll get all my future market updates because we're now in a critical time. But let's step back for a moment and look back at the past. What you're looking at here is a chart of the SP500 in 2009 when it bottomed exactly 12 years and 1 day ago at an intraday low of 666. And the stock market then went into a massive bull market. But that intraday low marked a historic cycle turning point. And a funny thing happened on Friday, exactly 12 years ago from that S&P 500 bottom. The 10-year Treasury bond hit an intraday low this Friday at exactly 0.666. Perhaps that's a cruel joke, but what I think it represents is a similar mega turning point for the financial markets and the bond market that's going to play out over the next decade. Now I know this weekend at this moment people are really not thinking about the bond market. They're thinking about the gyrations in the stock market. And let's look at this chart. This is a chart of the S&P 500 and it had a nasty day on Friday and then took back much of the losses going into the close. But on Friday, the VIX actually went to a new high for the year, surpassing the intraday high it made the other week, even though it closed below 42 on Friday. That type of action in the VIX, I believe, sets up a positive divergence for the stock market, more fear, but not lower lows made in the stock market. And that should set up a double bottom pattern here for the coming week. That is what should happen, but obviously these gyrations create uncertainty for all of us looking at it. But we do have this positive development for the coming week. And honestly, I bought some stocks, did some buys on Friday. In fact, the price action is sort of similar to the way things played out in 2018, the last time there was manic selling in the market this fast. In fact, well, I would say this event has surpassed that one. But still, retests are pretty typical in volatile markets that come off their highs like this did. And in 2018, as you can see, the market basically continued to trade in a very volatile manner from February to May before kind of then turning up and rallying until late September there. But in the end, what I think is the real story happening is what's going on in the bond market. And what you're looking at is the data from the U.S. Treasury Department website showing the closing yield on the Treasury bond market for Friday. So the 30-year bond is currently yielding 1.25%, the 10-year bond 0.74%, and the 1-year bond 0.39%, absolutely amazing, and the 1-month bond at 0.79%. Even with the Federal Reserve interest rate cut of 50 basis points made last Tuesday, the current Fed fund rate remains above the 1-month bond yield and the 10-year bond yield, which tells us that more interest rate cuts are going to come. But with interest rate yields this low in the bond market, it makes me ask myself, does it make any sense to buy these bonds at all going forward? I don't believe it does. Why would I want to lock up my money for 10 years to make 0.79%? much less 30 years at 1.25%. And even though inflation may be low now, there is no reason to believe that over the next 10 years, inflation rates will not surpass these low levels of yield that the bond market is delivering for Treasury bonds. And this sets up a problem that I face and you face, and anyone investing in the financial markets faces now. Does the bond market make any sense from an investment standpoint? I would say it does not. And for further evidence for this proposition, take a look at this. This is the current yield for BBB bonds. Notice the yield has collapsed on this chart and is now yielding 2.65%. Now, consider that when yields on bonds go down, the value on bonds go up. This means that bonds are trading at what are essentially record high prices. Treasury bonds are at record high prices because they're at record low yields. And these low yields, we're in a crisis type of environment where a lot of money, yes, is rushing out of stocks and into bonds. That's why the corporate bonds, those BBB rated bonds, are going up in value and the yields are collapsing. But this is not something that is going to continue indefinitely. And all this is setting up what is going to come when this moment of stock market gyration does end. Even if we go into a bear market in the stock market, this manic type of money movement out of stocks into bonds will end one way or the other. And when it does, these corporate bonds are going to go into a bear market. And I think if you have CDs, I'm speaking myself, I have CDs coming due, and I'm not going to put more money into bonds. As I have bonds that come due, expire, and turn into cash, I'm going to park that cash. I see no rational reason to put money locked up in 1-year bonds or 10-year bonds that yield nothing, especially if we have inflation one day higher than these current yields. These investments no longer make any sense, and they're just we are seeing the process being made of an epic top in the corporate bond market. Now, I don't say that about the Treasury bond market because I think what is going to end up happening is more and more people are going to look at these yields and say, I don't want to buy that. I'm just not going to do it. And what is going to end up happening within 12 months, perhaps 6 months or even 3 months, is the Federal Reserve is going to begin a new quantitative easing program in order to buy these bonds yielding such low prices that no one else is going to be buying them, especially the long-dated bonds at some point. And the Fed is going to step in. They've basically laid out that plan. Jerome Powell did in a speech last week, and other Fed officials have said that they plan on capping the yields and doing the buying themselves at some point in the future as a tool of monetary policy. So locking your money up in bonds for years no longer makes sense. Instead, what do? There's only really two choices. One choice is to have it in cash, so you can be flexible when you think the stock market has fallen far enough that it then makes sense to buy, or you want to trade with the money or whatever. You use it for something else other than locking your money up in bonds. And that turns us to gold. Gold is going up. Last week, gold went up again, and gold is up for the year. Gold went up last year. Gold has been beating the stock market really since October 2018, outperforming it. And the indicator on the bottom of this chart is the gold divided by S&P 500 ratio. That ratio goes up when gold beats the market, and lower interest rates makes gold more attractive to institutional investors and people who say having a lot of money in bonds no longer makes sense. I don't want to put that money into stocks. I want to put it into something safe, something less volatile, and that is what gold now is. Less volatile than the stock market and with more upside, because the lower rates go, the more gold is going to go up. And when those quantitative easing operations begin, the price of gold is simply going to go up even more. And when Treasury bonds continue to yield nothing and inflation does materialize at some point in the future, gold will completely explode. This is the macro environment being set up. You know, the stock market movements up and down on a short-term basis is one thing. I'm hopeful that we are in the process of some sort of double bottom being made, whether that's going to create a failed rally down the road or set up a continual bull market is one thing, and what is happening is making the odds of a continual bull market diminish, but it doesn't. These are all questions to figure out together as things unfold. What is more certain is the gold trend. Gold has broken away from the stock market. When the market was dumping on Friday, gold was up that morning. As it means gold's going to go up every day, but it means gold is now becoming the simplest thing to use to make sustainable gains going forward now. So those are my thoughts with what is happening in the markets. Again, if you're not on my email list, you got to get on it. Click the link associated with this video to do just that. And I'll be talking with you later.